Hello and welcome. So, let's talk about India's Nifty 50. It's been on an absolutely incredible run, right? But now, well, it seems to have hit a wall. It's just stalled. So the big question on everyone's mind is, what's next? Is this just a pause or something more? That's what we're going to unpack today.
Right, so is this the market just taking a healthy breath before the next big sprint higher? Or is this a sign that the momentum is finally fizzling out? To really figure this out, we're going to look at three key pieces of the puzzle. First, what the charts are telling us. Second, the real-world fundamentals of the economy. And third, what the top analysts are actually forecasting. So let's dive in.
All right, first up, let's play detective and decode the market's chart. You know, the price action itself can tell a fascinating story, so let's see what it's whispering about the market's mood right now.
Okay, a really big clue comes from what we call the daily candlestick chart. If you look closely at the recent candles, you'll see these long upper shadows or wicks. Now, what does that mean? Well, it's the chart's way of telling us that every single time buyers tried to push the market higher during the day, sellers came storming in and pushed it right back down. It's a classic signal that the upward momentum is starting to run out of gas.
And this slide, it perfectly captures the market's inner battle. Seriously, think of it like a tug of war. On one side of the rope, you have these really good signs of long-term strength. The index is still way above its key long-term averages, and some of the big momentum indicators are still flashing green. But pulling hard on the other side is all that short-term weakness we're seeing. It's this constant push and pull between the underlying bullish feeling and the immediate pressure to sell.
And here's something else adding to this picture of a stalemate: the India VIX. It's often called the fear gauge, and right now it's at an extremely low level of 10. You know what that tells us? It says traders are pretty chilled out. They aren't expecting any big, scary price swings. They're basically betting that the market is just going to stay quiet and trade in a tight little range for now.
This table really maps out the battlefield for us. You can see it clear as day. There's a ceiling, what we call resistance, right around that 26,000 mark. That's where the sellers are really digging in their heels. And then below, you've got this solid floor or support between 25,700 and 25,650 that the buyers are defending. And what's super telling is that the options data, where traders are putting real money on the line, it confirms this exact same trading range.
So the charts are telling a story of a short-term stalemate, a market basically stuck in the mud. But what about the bigger picture? Let's zoom out from the day-to-day price action and look at the actual economic engine that's supposed to be powering all these companies.
And let me tell you, the story here is incredibly strong. In fact, India's central bank, the RBI, just used the term rare Goldilocks to describe the economy. And what does that mean? It means things are not too hot, not too cold, they're just right. For investors, that's pretty much the holy grail. It means you have a stable, predictable environment that's just perfect for companies to grow, without the scary threat of runaway inflation.
And just how strong is that growth? How about a stunning 8.2% in the second quarter? I mean, come on, that is a powerhouse number that just proves the economic momentum here is very, very real.
And here's the other side of that Goldilocks coin, which is just as amazing. Inflation is almost non-existent. At just 0.71% in November, prices are super stable. And that gives the central bank a ton of flexibility to keep supporting the economy.
And guess what? They're using that flexibility. Because inflation is so low, the RBI just went ahead and cut its key interest rate down to 5.25%. This makes it cheaper for businesses to borrow, for people to borrow. It's like another shot of adrenaline for an already strong economy.
Now, all this economic strength is showing up in company profits, but there's a little twist. The latest earnings season was good, for sure, but the growth wasn't spread out evenly. The big energy, industrial, and IT companies did fantastically well, but the more defensive sectors, like everyday consumer goods, they actually fell behind a bit.
Of course, it's never a perfect picture, right? We have to keep an eye on a few potential bumps in the road. The trade deficit is on the high side, the rupee has been getting a little weaker, and as always, what happens in the rest of the world, especially in the US, can still send ripples our way.
Okay, so we've got a market that's stuck in a short-term tug-of-war, but it's sitting on top of a powerhouse economy. So what do the pros make of all this? Let's open up the analyst playbook and see what they're predicting.
And what's just so striking when you look at these forecasts is the incredible consensus. I mean, just take a look at these numbers from the big global banks. We're talking Jefferies, HSBC, Citi, Nomura. They are all, almost without exception, bullish for the year ahead. They're all calling for the Nifty to climb to 28,000, 30,000, maybe even higher by the end of 2026.
But, and this is a really important but,
While they are all super optimistic about the long term, pretty much every single analyst agrees that for the next few weeks, the market is likely going to go, well, nowhere fast. They expect it to just drift sideways inside that range we've been talking about.
So, let's tie this all together. After looking at the charts, the economy, and the experts, what's the final takeaway? Well, it boils down to 3 key things you really need to watch.
It's really this simple. 1. Keep your eyes glued to the floor at 25,700. As long as the market stays above that level, the bulls are still in charge. 2. Don't be surprised if any attempt to rally hits a brick wall near the 26,000 ceiling. And 3, the most likely path for now is just a simple sideways grind between these 2 levels, at least until some big piece of news comes along and forces a breakout one way or the other.
And all of this leaves us with a really fascinating question for the future. You've got this flood of money, we're talking billions of dollars, flowing from local, domestic Indian investors into the market every single month. So are we witnessing a fundamental change here? Is the Indian market slowly building its own fortress, becoming strong enough to just shrug off the shocks that come from the rest of the world? It's definitely something to think about.